Tonight, the match has already been lit. China closed the door on silver supply. Silver jumped up in price, and that one action just showed a weak spot nobody wants to talk about. The entire paper promises Tower is built on trust, and trust is the first thing that disappears in a crisis. Here's what really happened. Real silver got harder to find. Prices started to rise, and the conversation quickly changed. This is no longer, is silver going up? This is who can't deliver what they promised. Because the moment delivery gets questioned in London's trading world, the problem doesn't stay in silver. It moves into gold, then oil, then base metals, then straight into the machinery of interest rate swaps and currency swaps. You're with us here, shoulder to shoulder, and we're not here to worship a chart. We're here to spot the cracks before they break. Now, watch the chain reaction nobody is expecting. Derivatives aren't real things, they're promises, and promises only work when everyone believes everyone else can pay. London's trading market is basically a private poker room. Big players, big bets, custom-made contracts, and a clearing system that depends on confidence more than actual money. It works beautifully until it doesn't. The moment metal prices jump, the moment real metal gets scarce, the moment one player hesitates, the entire room goes silent. And silence is where panic starts. Because if silver's screaming deliver, every dealer asks the same ugly question. If my trading partner is short silver, what else are they short? That's when the rot spreads. Not because silver is magical, but because silver is small enough to move fast and violent enough to show hidden debt. Here's the mistake most people make. They treat silver as a sideshow, a shiny commodity, a betting toy. But silver is a tripwire. It's the thin wire across the hallway that tells you someone broke into the building. If this keeps running, the risk is not price. The risk is settlement. And if settlement gets questioned, it's not just a metal story. It becomes a collateral story. Now, let's talk about the part that hits you in the face. Stocks. Banks don't just own things. They use things as collateral. They lend against them. They rehypothecate them. They stack promises on promises, like building a skyscraper out of Jenga blocks. So what happens when the bubble pops? They don't politely rebalance. They sell. They dump stocks to protect loan books. They tighten credit. They pull lines. They go defensive. And when the biggest balance sheets in the world all try to run through the same exit at the same time, the exit becomes a meat grinder. This is where it gets ugly for anyone who thinks they've re-safe because they own different stocks. In a true unwind, correlation goes to 1. Everything becomes the same trade. Sell what you can. Now add the second wave, foreigners. There's a mountain of foreign money sitting in US stocks. They came for the liquidity, the momentum, the seeming safety. But safety is a story we tell ourselves when things are calm. When the market starts cracking, foreign money doesn't wait and see. It runs. It tries to convert paper claims into something it can carry. And if that flood turns into a stampede, the selling isn't slow, it's a cliff. Here's a hard question we need to ask ourselves. If the world has tens of trillions parked in US stocks, how much of that can realistically get out in a panic without destroying the price? Not much. In a rush, liquidity is a trick. It looks deep until everyone steps on it, and then it's quicksand. So yes, we need to take seriously the situation where indexes don't just correct, they get erased. 90% sounds crazy until you remember how borrowed money works. Borrowed money turns a dip into a collapse, and the collapse doesn't need a warhead. It doesn't need a meteor. It can start with something boring. Long-term interest rates. If long-end rates rise into a fragile stock bubble, that's like turning up the heat under a pot that's already boiling. Discount rates jump, valuations compress, buybacks slow, risk models flip, then the selling feeds on itself. The market doesn't fall because people change their minds. It falls because the math changes. Now pause here and look at the central bank's position. Not what they say, what they can do. If inflation is sticky and debt is enormous, policymakers are boxed in. Tighten too much and you blow up funding markets. Ease too much and you burn purchasing power. That's the trap. And traps force ugly choices. When officials tell you inflation is handled while groceries and rent still bite, that's not a victory lap. That's surrender dressed up as confidence. So if they turn into liquidity again, call it easing, call it support, call it ensuring plenty of reserves, the message to the world is simple. The currency comes second. This is where the real wealth transfer begins. Because when a currency loses buying power, your savings don't just earn less. They shrink in real terms. Quietly, ruthlessly, like a slow leak in a tire, you don't notice until the rim hits the road. And once the public finally sees it, they don't budget. They flee. They buy goods. They buy hard assets. They buy anything that feels real. That flight into real stuff is the death sound of a government money system. Now, connect that to what we're seeing in bond markets. When investors only want very short-term paper, they're telling you they don't trust the long end. They're telling you they see a debt trap. They're saying, I'll lend to you for a few weeks, maybe a few months, but I'm not locking my money up for 10 years. And that matters because long-term rates are the gravity of the entire financial universe. If that gravity gets heavier, stock valuations float less, real estate gets squeezed, corporate refinancing turns from smooth to painful, and the government's own interest bill starts eating the budget like termites. So here's the uncomfortable thought. What happens when the market demands higher rates, but the system can't tolerate them? That's when the printer becomes the release valve. And every time that valve opens, your buying power pays the bill. Now, bring China back into the picture. China didn't wake up yesterday and decide to restrict resources. This is long game behavior. They tighten the flow of important materials. Silver, rare earth processing, antimony, cobalt. The stuff the modern world can't replace with a spreadsheet that pushes input costs higher, squeezes manufacturing, and forces everyone else to compete for what China already controls. At the same time, they keep building a shield, gold. Gold is not a trade. Gold is an insurance policy against someone else's policy mistake. When a country steadily reduces exposure to G7 currencies, they're telling you they don't trust the future buying power of those paper claims. They're not attacking the dollar with missiles. They're letting the dollar collapse under its own weight. And here's the part most people miss. Commodities priced in gold can look cheap. Not a little cheap, historically cheap. That means raw materials can reprice violently in dollar terms without being expensive in real terms. That's why we can see a commodity surge. At the same time, stocks collapse. It sounds contradictory until you see the mechanism. Stocks are a claim on future profits discounted by rates and stability. Commodities are what you need when stability breaks. When the system starts doubting paper claims, the world reaches for atoms. That's why silver matters. It's not just an industrial input. It's a vote against trust. Now, let's walk into the room everyone avoids. Counterparty risk. If derivative markets start questioning counterparties, the spread spills into everything those counterparties touch. Interest rate swaps, FX forwards, credit lines, prime brokerage. And the second that happens, banks don't extend credit. They shrink, they hoard, they protect themselves first. So you get the nightmare combo, liquidity in the system but no willingness to lend it. That's like having water in the pipes, but the valve is shut. Central banks can flood reserves into banks, but they can't force confidence between institutions once fear takes over. They can't make a dealer trust a dealer. They can't make a counterparty feel safe. Confidence is either there or it's gone. And once it's gone, everything reprices. This is why rule changes start showing up. Capital requirements get adjusted. Certain assets get treated as safer on paper to encourage banks to hold them. And every one of those adjustments is a clue that the system is trying to duct tape itself together. Now look across the ocean. When regions with weak growth, heavy rules, and political fragmentation hit a global funding crunch, they don't get a soft landing. They get a hard stop. Credit tightens, energy costs bite, and policymakers argue while the market moves, and the market always moves first. So, if the US wobbles, the rest of the world doesn't sit comfortably. It tilts with it. Now, if China is positioning for a world where trade settlement shifts away from the dollar, they don't need to announce anything tomorrow. They wait until the dollar is visibly wobbling. Then, they offer the alternative at the exact moment the world is desperate. That's how power shifts. Not with a speech, with a solution. A new settlement structure, a stronger regional network. A currency system anchored to something that can't be printed. You don't need to believe in a perfect gold-backed headline to understand the reason. If trust in government money cracks, anyone offering discipline looks attractive. So the real question is not will they do it. The real question is when the pain hits, who has the plan ready and who doesn't. Now we have to be brutally honest with ourselves. The political system is not designed for cutting spending. It's designed for promises. And promises are expensive. So in a currency trust crisis, the path of least resistance is always the same. Print, patch, postpone. That's why we can't treat 2026 as just another year. It could be the year the public finally understands the difference between money and credit. Money is final settlement. Credit is somebody else's promise. When times are calm, credit feels like money. When times are rough, credit shows its teeth. If we're wrong, where will it show first? It will show in stress spreads, in repo, in delivery delays, in sudden technical outages, in banks quietly demanding more margin, in temporary measures that never go away. And when those signals appear, the window closes fast. So we keep it simple. We're not gambling, we're measuring. Now, let's zoom back to silver for 1 second because it's the spark in this room full of gas. It means you convert a slice of credit-based wealth into things that don't require permission to exist. Gold, select commodities, real productive assets, things that don't default because they aren't a promise. This is educational. We manage risk. And yes, there's a psychological war coming with this because when the system starts cracking, the headlines will be designed to confuse you. One day they'll say soft landing. The next day they'll say unexpected volatility. Then they'll say temporary liquidity measures. Then they'll blame a scapegoat. But the truth is simpler. If the currency is being sacrificed to keep the system standing, buying power is the victim and buying power is your life. So we stay awake. Now watch this final hinge. If long-end rates jump and stocks roll, foreign capital runs, and banks sell collateral, policymakers respond with liquidity. That liquidity pushes commodities higher. Higher commodities push inflation expectations higher. Inflation expectations push rates higher again. That's a feedback loop, a loop that eats portfolios. And in that loop, silver is not the hero. Silver is the alarm. So here are 2 questions we want you thinking about. We want you in the comments with real answers. If silver is rising because real metal is tight, what happens to a paper market built on will settle later. And if policymakers ease into inflation to save the system, what do we want to be holding when the public realizes it's not prices rising, it's the currency falling? One more thing we can't ignore. In a real dollar trust scare, it only takes one major group to say we're settling differently. Not because they worship gold, but because they need a firewall. The moment that happens, the dollar doesn't slide in a smooth line. It gaps. Everyone tries to front-run everyone else. Companies pre-buy inventory. Governments stockpile fuel and metals. Importers scramble for hedges. Ordinary people feel the squeeze and start converting paychecks into stuff. That's when inflation stops being a number and becomes a weekly shock. And here's the cliffhanger. The switch usually happens quietly at first, then it becomes contagious. And once it's contagious, it's irreversible. When you notice it, it's already late. That's why we move before the crowd moves. We're not ending this with a neat bow because crises don't come with closure. We're ending with a warning. The next phase won't be announced. It will be felt. It will feel like small changes at first. Wider spreads, weird headlines, sudden caution from banks, policymakers insisting everything is fine while you feel it getting expensive. Then it speeds up, and by the time the crowd agrees it's real, the exits are already jammed. So stay sharp, keep measuring, don't marry stories, watch the pipes, not the speeches. And if you want us tracking the signals with you, hit subscribe. Short, simple. Do it now. Because when the gap opens, we don't get a second chance to pretend we didn't see it coming.